Okay, traders, so welcome to chapter 4. During this chapter, we're going to be talking about selling premium and why we sell premium and how we can use premium selling methods to make passive income. So whenever you're thinking about selling premium, there's basically three choices. There's more, but we're just going to stick with these basic ones, okay? Number one, you want to sell an iron condor. What this means is that you're selling premium either at the money or out of the money. And let's say the stock price is trading right here. And what you're doing is you don't care if the stock goes up or if it goes down. You just want it to stay within a range. So if you do not have a directional bias and you just want the stock to stay within a range, selling an iron condor is the best thing to do. Now, for me, because I like to trade some of these hot flying stocks, I do typically avoid iron condors just because I usually have a directional bias. So what that means is that I'm betting on it going a certain way. And so, everyone's different. There's a lot of people who love doing it that way. For me, I'm a directional trader, so I like sticking with the direction. So for that reason, these two options are the ones that I normally use, but like I said, you can use any of them. So selling a call credit spread, what that means is that the stock price is either trading sideways or trading lower. And so what you're doing is you're selling premium above where you think the stock price is going to go. So when you're doing that, you're making the bet that you don't think the stock is going to exceed the standard deviation to the upside. The next portion, the one that I do the most frequent, is going to be selling put credit spreads. Now, why would I do that the most frequent? Well, because we're in a bullish trending market currently, and I like to trade strong stocks that typically trade higher. So for all of those reasons, I use this one the most often. However, as the market condition will shift and change, you will see that I'll use iron condors or I'll use call credit spreads. It just really depends what the overall state of the market is doing. So let's talk about this for a minute. Directional versus neutral. What is your bias? Well, I can tell you mine is generally directional. But it doesn't matter. What matters is that you find something that works for you. So directional traders, what we do is we're attempting to capitalize on the up or down movements in price on the underlying. So it's a little bit trickier, I would say, just because the stocks typically stay in a range about 70% of the time, and then 30% of the time they're taking off. So if you think about it that way, it's kind of like, well, this is a lower percentage of time that's happening, so why don't I capitalize on this? So you can absolutely do both, and to be a well-rounded trader, it makes a lot of sense to know both strategies. So the next piece of that is focusing on neutral or income trades. So when you're using neutral or income trades, what you're doing is you're capitalizing on the fact that the market's not really breaking outside of a range, and that is where you're making your money. Most traders utilize a combination of option strategies depending on the current market conditions and the technical setups that they're seeing. Here are a few of the most commonly used option strategies. As a directional trader, what we're looking at are long calls, puts, debit spreads, credit spreads, butterflies, and unbalanced butterflies can be used for direction as well. Neutral traders will use credit spreads, iron flies, iron condors, iron butterflies, unbalanced butterflies. Each strategy has its own positives and negatives, but typically traders are going to begin with the most simple strategies like a long call, and then they add on debit spreads and then credit spreads, and then they graduate to butterflies. So that's typically the way that it works, and the reason that it's that way is because these things kind of layer on top of each other. So with the long call, you just have one strike, right? But with the debit spread, you have a long call and a short call. With the credit spread, you can have a long call and a short call, or a long call and a short call and a long call. With the butterfly, you're stacking it. So you're doing long call, short call, long call. And so if you learn this first and then this, and then you learn how to add on butterflies, you're in an ideal spot. As far as neutral trades are concerned, especially the iron flies and iron condors, really all that is just a combination of these right here. So again, it's kind of a stacking method to learn and add one thing on top of the next. So it may seem a little bit overwhelming, but when you break it down, you just have to think about, okay, number one, what are you comfortable with? What do you like to use? Number two, what is the market environment like? In a very strong directional market, the best thing to do is to be using calls and butterflies so that you can maximize your upside. But when the market gets choppy or volatile, then the better things to do are to use spreads or condors. So it's important to have an overall viewpoint of what's going on there. The next piece of that is the technical analysis on the underlying. So it's always going to depend what the overall trend is on the underlying so that you can decide what you want to do. And then, of course, risk tolerance. You always have to pay attention to risk tolerance and decide what you're willing to risk in order to be in the game. Here's an example of some of our simpler strategies. I like to put them on this list as least risky to most risky, going from buying stock all the way up to buying and selling index futures. So depending on what type of trader you are and what type of market you're in, you're going to see a pretty wide range of these strategies right here. So let's talk about why premium selling makes sense. Well, we trade options because they're leveraged, because they decay, and because we can make money with neutral strategies. We're taking advantage of time decay instead of letting it take advantage of us. There's many ways to do this. You can sell in the money, at the money, or out of the money premium. But by selling premium further out of the money, it means less reward, but it also means less probability that your short strikes will become in the money and therefore losing. So let's take a look at standard deviation to demonstrate this concept. Here is the standard deviation of a stock, and let's say we're right here. Okay, this is always a zero line, which is where the stock is trading right now. Well, what this means is that this is a 1 standard deviation, this is 2 standard deviation, and 3 standard deviation. And this is the probability that the stock is going to stay inside of this range. So when you're looking at this and you're saying, okay, what's the standard deviation for this week? The probability that it's going to stay inside of 1 standard deviation, both to the upside and to the downside, is 34% on this side and 34% on this side. So it's going to be 68.2% that you are going to stay within a 1 standard deviation move. Now, when you add the technical factors to this, which is the overall trend, and you say, okay, well, yes, there's a standard deviation there's a probability of 68.2% that I'm going to be staying within this range. Okay, that's great. But then if you also add the technical setup of this is a trending chart and it goes higher more than it goes lower, you're upping your percentage and enabling yourself to sell closer at the money because you already have this probability you're staying within this range, but you have an even higher probability that the ticker is going to trade higher instead of lower. So you're really upping your probabilities. Now, notice on this graph, we also have 2 standard deviations. Now, in the class, I haven't been going through all the different 2 standard deviation levels primarily because I don't ever sell it this far out of the money. If you're going to do that, honestly, a good way to do it is doing it on purpose so that you can be assigned the stock. So a lot of traders will have strategies where they will sell 1.5 standard deviation or 2 standard deviation puts. And then if they get assigned the stock, then they're happy with that and they take the assignment and all is well and good. I don't actually take assignment, so I'm trying to avoid that. And when I'm selling a spread at 2 standard deviation, it's not going to have enough credit for me. So I did put it on the spreadsheet in case you were interested in doing that, especially to accumulate stock. But I did want to tell you that I personally do not do that, and that's why it was not covered in this class. So let's talk about the varieties of spreads here. So number 1, we have put credit spreads. Put credit spreads, why are they the least risky? Well, also this does depend on what standard deviation you're selling them at. For example, if you're selling them 2 standard deviation or 1 standard deviation, then yes, they're higher probability that they're going to work, but the times that you get killed, it is going to be a problem. So you have to watch this very clearly. So when I'm saying risk, it's all relative. But overall, put credit spreads are most definitely less risky than call debit spreads and long calls. Why? Well, number one, you're getting in for a credit. You have defined risk. You can make money. This is a key part right here. You can make money if the market trades sideways, trades slightly higher, or explodes higher. In a volatile market, they're easier to hold than riskier strategies. That is the main reason why these are great strategies. What about call debit spreads? Well, call debit spreads are moderately risky because they do have a defined debit that you pay to enter the trade. They have a defined reward, and they can make you money if the market trades moderately higher. In a volatile market, they're easier to hold than riskier strategies. Now, they're great, especially when the market is trading in a direction. It's a good way to maximize what you're trying to do. But again, that's not a premium selling strategy. You're getting in it for a debit. You're not selling for a credit and then watching theta decay. So it's just a little bit different. And then long calls, of course, you do need the market to trade higher for your long calls to actually make you money. Now, these are the best. These are the best for maximizing upside. I mean, that's always going to be the case. If you want to maximize upside or maximize downside, puts, of course, then in that instance, yes, you want to use those long calls, but those are going to be more risky. So you have to know when to do it. All right, so let's go ahead and talk about selling out of the money put credit spreads. So when would you do this? This is a very, very important piece here. So you want to do this when you're expecting the price of the underlying stock to fall slightly, stay the same, or rise. This is a very key point here. So the reason why put credit spreads are good is because the market doesn't have to go straight up. It can actually, the stock can go sideways. It can even go slightly down, or it can go higher and you can still make money, which is why put credit spreads are really nice. So within this diagram, take a couple minutes to look at it. You have an underlying price right here, and the profit in this trade is going to be when the price of the underlying plus the current option price stay above the break even. So when you're looking at a put credit spread, you're going to have your profit potential right about here, okay? As long as the stock price stays above where your short put option is, that is where you're making your money. The biggest amount of risk is right in here. So once you kind of cross over the short strike and you cross over the credit you receive. So for example, if your short strike is at 100, let's just say, and let's say you took in a 50-cent credit. So the second that you go under 99.50, because that's the short strike and then the credit, that's when you are losing money. So with the 7-stock strategy, it's really important that you're paying attention to where your break-even price is. You want to know where that break-even price is, and you really should set an alert at your break-even price in case the market is nearing that area. Because once you get to the break-even, you really do need to close out your trade. Because the problem is that because you are risking far more than what your reward is, you do not want to turn your 50-cent credit into a $3 loss. So it's very, very important to keep your alerts and pay attention to where your short strike is so that you can get out when you need to. Now, let's talk about the difference between an out of the money and an in the money put credit spread. An out of the money put credit spread is sometimes regarded as safer because the underlying is further away from the strike price. Your risk reward ratio is higher. You're also less likely to assign because it's out of the money. Now, in this segment, looking at both and how they're similar, they both can be bullish trades. They can both make money if the market trades sideways, and they will both make money if the market stays above the short strike at expiration. With the in the money put credit spread, people will typically regard it as a little bit riskier just because it's in the money. But for me, as I've been able to hone my directional skills, I honestly, I like it a little bit better just because I am able to take in more of a credit. So it just kind of depends, again, what you're looking for. But the reason why I like this is because the risk reward is around 1-to-1. Depending on how you set up the put credit spread, you can be risking 3 to make 1 or 4 to make 1, which again, they're highly probable, whereas these are less probable. So it just depends what you are going for. So that about wraps up this portion. Next, I'm going to get into selling premium, bullish, bearish, or neutral, and I'll see you in the next chapter.